Silver Dave here. Gold and silver has been quite volatile over the past few months because people have been news trading. So what can you do to protect yourself against extreme volatility and not get burnt on a peak? Well, let's find out. So when we stack, we want to get the most silver and gold for our money. You don't want to, yes, of course, this is real money. It has value. It will always have value. But the problem is you want to get the most out of your fiat currency today. So what does that mean? Does it mean that today you need to go out and buy all the back up the truck? Like a lot of people say, right now, silver or gold, you back up the truck and then it's going to go for the moon. Don't do that. I've said many times on my channel, I will never advocate for you to go and back up the truck and hope for a moonshot. That's not how, that's not how you work in preservation of wealth. Because you have to realize, in the long term, yes, gold and silver has value, right? And even in the long term, if you buy at a peak, and you will still, you will still preserve value over the long term. But we want to make it so that, you don't take too much risk. You don't take too much liquidity risk. And whatever you do, the less risk you have in terms of wealth preservation, the better it is. Gold and silver are not very risky items. Like I say, gold and silver can never default on you. Gold and silver can't do a bank run on you. Gold and silver, they can't suddenly over the next day decide to suddenly print 1 trillion tons or 1 trillion ounces more worth of gold and silver. It just can't happen. There's physical limitations. It has to be mined, it has to be refined, it has to be processed and made into bullion form. There are a lot of physical limitations on gold and silver that simply cannot be overcome by a simple decision, just unlike the dollar, or especially like the digital dollar, which they can suddenly decide to just change, reserve rates, and then suddenly all the banks are flush with computer numbers. You can't do that with gold and silver. So what I want to present to you, and I've presented this many times across my channel, is you should cost average. And why should you cost average? Well, cost averaging sort of, it smooths out the upwards peaks and the lower bottoms because you're buying across time and many different moments. And it allows you to create sort of an average price of you buying. And if you are doing that, pretty much you are protected against day-to-day volatility, which is what is happening in gold and silver. Now, it's easier to do with silver because silver's price is relatively cheaper, right? Silver is under $30. Silver is under $25 at this moment. I don't know where it will go afterwards, but silver is cheap relative to gold because many people can go out and buy a tube of, let's say, or 10 ounces of silver. But I doubt anybody can just go out there and buy 10 ounces of gold. And even 1 ounce of gold is a stretch for many people, right? A lot of people I know, and at least that I talk to on forums and everything, they don't like gold because you have to sink so much money into it at once. So what can you do to cost average? Well, I'm going to show you two things. For silver, it's pretty obvious, right? You just buy a few ounces. I typically, the way I do it is if the price is good, I buy 5 ounces of silver. And that's like my small cost averaging. And if the deal is really good, I can go up to 10 ounces of silver. And then typically I buy them in batches of 5 to 10 ounces of silver. Like I bought these two. These were two different batches. This is another 10 ounces. The price was different. On average, I paid around 26 Swiss francs for the two batches. Okay, so that's pretty clear. You can do this with silver and you can get quite a lot. Gold, if I was doing it with 1 ounce gold, and let's say I bought it at the beginning of the month when gold was still in the 1900s, and then the next month I buy and it's still high, because gold, unlike I would say previous years, gold at this moment is quite volatile. It's more volatility than you see typically with gold and silver. And if you're in the optics of being a wealth preservation, method using gold and silver, I'll put up the gold charts so you can see like how volatile gold has been. But typically, I would say traditionally, gold, you never saw more than like a 3-4% movement over a day. That would be a huge movement for gold. But right now we're seeing even like $100 drops. I think early in the year we saw this massive crash. It was unexpected. It's not a normal behavior for gold. For silver, it's more common. And this is a subject I won't get into because a lot of us, we stack silver because it's cheap. We don't stack gold because we see gold as being something that you can't really put a little bit of money in, and it's really not affordable for everybody. That's the real reason, I think, why a lot of people can't stack gold. And that's why gold stacking isn't really widely adopted, because it's almost exclusive and somewhat elitist to be stacking gold. So what have I done? Because when I did my analysis about gold and silver, what I realized was gold tended to perform better than silver in terms of long-term preservation. And you're like, yeah, but silver has so much more potential. Yeah, potential goes both ways. And what I found was that gold had better consistent. It didn't mean that in certain periods silver didn't perform better than gold. What I found was that gold, let's say if you're stacking for 50 years, 60 years, gold performed slightly better than silver. And that's what I'm getting to. I'm getting to that if I'm in the, let's say, perspective of stacking for my retirement, gold is a much better item to hold than silver. I also, right now, I'm buying some platinum. Like, you're like, yeah, but you don't just buy gold, you also buy silver, and you buy platinum. Why are you being so inconsistent? I think silver is cheap. That's why I buy some silver. Every time silver goes down a bit, and I see it's cheap, I buy a little bit. I'm also buying platinum right now because it's super cheap. Platinum right now is really, really, really cheap concerning what it is and how and its price relative to gold and other precious metals and other assets. It's just rock bottom. So that's why I'm also buying a little bit of platinum. I was thinking of picking some up this month too. At the end of the month, I was like, maybe I should pick up another lunar ox because the price on them is okay right now. But I just saw recently that the price of lunar oxes went up about $100 more than what I paid for it. So 10% more than what I paid for this coin. And I'm like, I don't know. I'll see I'll have to see if I can buy a cheaper option of platinum. Maybe I'll buy a platinum bar or something. Anyways, back to the topic. So what I wanted to present to you is the idea that we can go into gold bit by bit, right? The main reason silver stackers stack silver isn't so much, I think, because, silver's much better or worse or so on, or there's more money to be made. It's that it's cheaper. And I buy silver because I'm a cheap ass. I like getting the most for my bang on my buck. And I wanted silver when it's on the low because it's cheap. That's the thing, But right now, I'm also realizing that in the long term, when I look at sort of the history of how well gold and silver perform, I'm seeing that gold, they're correlated, but gold outperforms silver in the very, very long run, so 30 plus years. So what am I doing? Well, I'm slowly getting into gold. I'm mainly a silver stacking channel. Most of my stuff is silver, but I'm figuring out my personal strategy for getting into gold. And the way I've been getting into gold was I was thinking, okay, I don't want to buy 1 ounce at a time. Is there some way over 2 months I can buy half an ounce? And per every single month I buy 1 ounce, but I buy it in segments preferably of quarter ounces or even lower, like a 10th ounce, however low I can get. Then I went online and I looked at what was available, and I saw that there was just like such high premiums. There was just stupid premiums on silver. I'm sorry, on gold. And I was like, silver also has stupid premiums in a lot of places, but sometimes you can find good deals. On gold, there was, especially for fractional gold, like a quarter of an ounce and a tenth of an ounce, there was just like really dumb premiums. And I was thinking, wow, that breaks the whole purpose of going in slowly. Because, like I say, if you're trying to cost average and you're only paying 20% more for physical gold, you're not cost averaging, you're getting scammed. I mean, I understand why it's so high, the premium, because it costs the same amount to make like a small coin compared to a big coin. But still, you know, I'm not saying that it's not justified. I'm just saying that it's not a good strategy to do it, to burn money. That's what I'm saying. So what I was looking at, then I still was like going around the different sites. And on every single site, it's almost like this, that the cheaper, lower premium stuff is always at the bottom of the site. Like you have to really dig into the bottom of the site and to find the lower premium stuff. And this is what I found. I found that like the old bullion, that means old school, like European bullion made in the period of before the First World War or before the Second World War, they were cheap because essentially they were gold in bullion format. And the cost of manufacturing has already been completely like amortized. It means that they're gone. There's no, I mean, over time, it's depreciated to zero, the cost of manufacturing. And people are not buying them. People don't buy the old bullion coins. I'm like, why aren't they buying old bullion coins? I was thinking about it a little bit. I was thinking, yeah, there's no marketing around it. Nobody's going to market to you 20 Swiss franc gold coins. I mean, because nobody makes money off selling these, right? The dealers might make a little bit. Sometimes they put it on sale, but the mint, the margins on these are much lower than the newer American Eagle. So there's no point in selling old bullion. The old bullion is something that, you know, eventually they hold and it goes on sale and they're like, they just like sell in mass our old bullion. But everybody recognizes that it is gold and they will buy it. They will buy your old bullion. Banks will take it as gold. It is considered as gold and it's good as gold. And we're here to stack, and it means that we want to get the most out of our money. So what I have here, I want to physically show you how it works out, right? I cost averaged over the period of roughly 4 months, roughly. And I did buy some of these items on sale. So they went on sale, they were close to spot or even slightly under spot when I bought it. And this is how much it cost me over the period of a bit more than 3 months. So between 3 and 4 months to get 2 ounces of gold. So you're like, how does it come up? So this is roughly 32 grams of gold, and this is 30 grams of gold. And that's 62 point something, a little bit more than 2 ounces of gold, but roughly this is 2 ounces of gold. It's the same gold content as if you bought 2 gold eagles. Now, if I bought 2 gold eagles during that period, I would pay much more. I'll show you why. So the total cost in Swiss francs, this is in Swiss francs, for me to buy these 2 ounces of gold, and I bought it was fractional gold, one at a time. I would say I was buying a little bit under a quarter of an ounce at a time. I paid 3,617 Swiss francs, right, for 2 ounces of gold, which comes to 1,808, a little bit more than 8.5 per ounce. And if I was to sell this today, it would be 1,700 Swiss francs, which means that I have a spread of 5.9. Now, you're like, yeah, but you're losing money when you're cost averaging. So I'm going to show you something else. I'm going to put it onto the screen. If I was to buy this today in a gold buffalo, right, I would get roughly the same spread. I'll put the picture of the gold buffalo into, this is the first time I'm just going to do everything digitally. So I'll put the photo of the gold buffalo in the video. You should see it right now. For the Gold Buffalo, I would pay roughly the same spread. The Gold Kangaroo, which from my usual dealer is on sale, I'll pay slightly less. And for the Gold Philharmonic, it would be, and the Krugerrand, it's roughly the same price. So it means that during this period, and I've seen this currently when I look at how gold has been, the price of gold has been moving, gold has really just moved only 1 to 2% overall. But the daily volatility, you know, people were saying, yeah, but it dropped 100. Yeah, it dropped 100, it went back up, and then it dropped another, you know. The band that it's been trading at has not changed. So if you take the average of all the volatility, it actually moved, it's zero, it hasn't moved at all. So what does that tell me? That tells me that if you don't want to get burned by sideways trading volatility, cost averaging is probably the best strategy. And I wanted to show you this today, you know, by making this, by showing you that I got 2 ounces and I paid $1,808 per ounce, and I have a 5.9% spread, and I've been buying this over the course of over 3 months. Now, I paid after the drop. I bought this after the drop of the massive drop of gold, after there was a tremendous bull rise and there was an initial drop of gold. And even though there was this moment when it dropped over $100, because I was cost averaging, I was also buying a little bit during that period after the drop. So my average today, now that's come up a bit, it's pretty much on spot. I mean, I'm pretty much at spot with all my gold. Is it a good strategy? I think this strategy, it works, but it has limitations. Let's say if gold completely crashes, it tends to not work out so well. However, gold rarely crashes, makes huge movements and huge crashes. Now, are there things that make this type of strategy not work? Yes. So remember I was saying that I was looking to get into little by little. One of the things that you should not do when you're trying to employ this strategy is to pay a lot of premiums. Because remember when I said my spread is 5.9, the reason why my spread is so low is because I'm paying almost no premiums when I buy these gold items, right? When I buy this gold bullion, I'm paying almost no premiums. If I was doing the same with like quarter ounce or 10th ounce, my spread today will be closer to 15 to 20%. Now think about that. That is almost like 15 to 20%. Yeah, that's 15 to 20%. I will never get back, right? That's a spread. The spread is essentially your immediate like loss because that's the amount that, you know, between the sell price and the buy price for physical gold that you're never going to get back. And that's why I say when you buy gold, and even if you're trying to get into a little bit at a time, take care of your spreads. Make sure that you're not buying too high of a premium. And that goes for silver too. The reason why I've been slowing down silver, and you know, I'm like looking at silver, I'm like, yeah, I could cost average over the long term, it might work out. But I do feel silver is somewhat overpriced, but not really, you know, there's another problem with me when I buy silver is that I always have a fixed at least 7% premium plus whatever premium the dealer's charging. So I'm always at like above 17% premium, which is kind of tough. So I either have to go and find individuals to buy it off, or I have to, and then I have to deal with verification, and it takes me more time. But gold, I can buy off dealers at almost no premium when it's on sale. So to get back to the point, premiums, bad for cost averaging, bad for your stack, and try and find stuff with low premiums and cost average is going to protect you during volatile times. Now, the second thing I want to talk about is shipping. Shipping is something that you have to be aware of. When you're cost averaging, this goes back to the spread. You want to reduce the spread as much as possible. Let's say you can only afford a 1/10 ounce equivalent in gold, right? You cannot afford 1/10 ounce is roughly a little bit under $200. Let's say you can afford $200 of gold. Should you go buy that 1/10 ounce gold eagle? I don't think so. I don't think you should go buy that 1/10 ounce Gold Eagle and have it being sent to you. I think then it might actually be better for you to buy silver if you can get it without a premium. And especially if you're buying weekly. Now, if you're trying to get into gold and you're trying to spend less than let's say $200 a week, what could you do? Well, I would say you could probably buy, either you have a choice. You have a choice to wait, 2 weeks. So you buy twice during a month, and buy some 20 Swiss franc or French 20 franc gold. These are very interesting coins because of the lower premiums. But even when you do that, you have to be aware that shipping costs can skew your premiums because you're buying such low quantities. Every single dollar of your fixed costs, which means that shipping costs, is going to jack up your spread. So that is something else you have to be aware of. Of course, a lot of bullion dealers, they want you to spend a lot. So I've seen quite a few dealers, especially shipping to Switzerland, and some Swiss dealers, they want to charge you extra for shipping, so that when people do their calculations, when the shipping is so high, they tend to order bigger quantities. And the dealer I use tends to actually have lower shipping costs, which is one of the reasons why I use them, is because I can order small quantities without worrying too much about shipping costs. And there's the local dealer, the one that I can go in and pick stuff up. They don't have shipping costs for me. So that's why I was able to buy, and it's on my way to work. So that's why I was able to buy very, very cheap gold. I wouldn't say it's cheap. Gold isn't really cheap. But I was able to buy low premium, almost no premium on my gold, and cost average. That's how I was able to achieve my decent cost average. Now, the final thing I want to mention. Now, this is something that you have to be aware of. Like, I've talked to different of my viewers, and some of them are from different countries. Like, I have some Canadian viewers, they'll tell me, yeah, but for me, I can only buy 4/9 gold. I'm like, why can you only buy 4/9 gold? They're like, yeah, because in Canada, if it's not 4/9, you get tax on it. I'm like, oh shit, that's not great. And if it's for example the Swiss franc, the 20 Swiss franc, right? The 20 Swiss franc at bullion quality in Switzerland, like, I don't even know if this is just bullion quality. I don't know if I can focus on it. Let's see if I can focus on it. You can see that the coin it's in pretty good shape. I'd say this is like fine, and not just, I have a few that have some markings. Even this French 20 French franc, the quality is, it's almost unmarked. Okay, so these coins, they haven't been marked too much, but there are some that are more marked. But going back to talking about your locality, it's important to know what are the tax laws around your country, right? For example, for me, it was important to know that, like, I had tax on silver, I had tax on platinum. So for me, it has to be really, really cheap for me to go in and buy it, or I have to really like the thing, and then I want to pick it up. And I don't find this product, for example, the silver Dragon bars, I don't see many of them around in Switzerland. So they have quite a bit of a premium. There's a bit of a numismatic aspect to it. Gold bullion, less so of a numismatic aspect of it. So I'm lucky that in Switzerland I don't have tax on this. But like I said, some of my Canadian viewers, they can't really go in and buy this. They can't cost average using this. They have to cost average using 4/9 gold. And 4/9 fractional gold, there's not much of it out there. You don't have many options. 4/9 fractional gold means that you have the Philharmonic from Austria, you have the Kangaroo, and you have the Maples. And I'm not sure there's more 4/9 fractional gold out there. And all of those coins have quite crazy premiums on them. I mean, any of them have like between 15 and 20% premiums on them. So it's not great. So I think for my Canadian viewers, you gotta either buy the 1 ounce coins or bars. Maybe you can find some like some good for delivery bars, not just random bars, but good for delivery bars sealed, and that could be part of your gold, entry point for gold. But even then, some of those bars are pretty expensive. If you go and buy a 1 gram bar, it's got the same amount. I think a 1 gram bar is almost $15 above spot. So it's expensive. It's like a 25% premium. You can go for the 5 gram bar. That's a little bit less. That's closer to the premiums of this, but you're still paying, I would say you're paying almost 8% premium on that, which isn't too bad. It's not too bad. It's not too terrible. But it's not the best. It's not like zero premiums or at least a 3-4% premiums. Yeah, so what I wanted to get at was that you can, if you have to know the tax laws of your country. I know that in the United States, silver for some states don't have tax. I talked to some of my viewers, and they mentioned that in Texas, for example, you don't have tax on silver. So that's how a lot of people, I would say that they're not saying that. Here's the funny thing about humans, is that we do things intuitively, because we know that it's good for us. So when people start buying a little bit of silver at a time, they're intuitively cost averaging. I think a lot of us do it. We cost average, but we don't really consciously know that we're cost averaging and why we're doing it. But we're intuitively like, oh, we got burnt once when I bought a lot of silver. It dropped, so now I'm just buying a little bit at a time. That's cost averaging. You don't consciously need to know about it, but that's what you're doing. So a lot of people, maybe they bought some silver, they got burned, and then they're like, okay, silver is quite volatile, so they buy a little bit at a time. And if there's no tax and you have access to a local coin shop that deals this physical silver and you've got cash, it's not a bad deal. It's a pretty good deal. It might even be better than gold because you can go in a little bit at a time. And gold, fractional gold, has a lot of premiums on it. Now, if you're flush with cash and you can spend, I don't know, you can buy 4 gold eagles every single month, and have cash left over to live, I think you can do that. But of course, then you're pretty baller. I mean, that's a lot of money. If you can spend 1 ounce of gold every single 4 times across your month, yeah, that's a lot of money. What I was doing when I was buying this, I was buying sort of every single 2 weeks. I was buying 1 coin, like 1/4 ounce coin, and it was almost a stretch, and I was supplementing it with a little bit of silver. So because I know the premiums on these were so low, I was like, okay, I can take a little bit of a hit on the premiums of these and balance it out with a little bit of silver. So I still have a little bit of a premium, but it's not as if I went all in on silver. That was my strategy. Did it pay off? I would say it kind of paid off, the strategy of trying to balance out the volatility. Remember, I started buying more gold about 3 months ago, so it was not like the cheapest gold you could buy. It wasn't like before July, I was buying gold and suddenly I had a huge jump and my cost average is great. During this period, gold has been there's like a relative volatility. If you look at the moving averages, that means the short-term moving average and the long-term moving average. The short-term moving average is above it, and the long-term moving average is below the price of gold. So I would say that it's in a volatile trading period, and if you're trying to balance out and buy a little bit of gold, like up to 1 ounce, but you don't want to plunk down that that 1 ounce cash, that almost $2,000 of cash in one go, and then see the next day have let's say you bought let's say you're really unlucky and you bought a 1 ounce gold coin before the vaccine news crash. You would have lost $100 in that one day. That would have been $100 is 5 ounces of silver. That's a little bit less, 4 ounces of silver. So yeah, that's not a good deal. But if you bought in just a little bit at a time, even though there was a huge crash, you could average it out and buy a little bit more. You wouldn't lose all your whole pants during the whole crash. That's what I'm trying to get. When you go in a little bit at a time and you keep a little bit of cash back for the short term, it's not a bad idea. Now, this channel, like I say, I never tell my viewers to go all in. I'm not a financial advisor. I have no idea when is gold at its lowest or when it's at its highest. I only look at previous data and say okay, in the past, it kind of did this. maybe it could still do that. I'm not a technical analyst. I can't tell you, oh, this pattern, it's going to lead to that. I don't think it's fully bogus, but I think it's also like a little bit like, tea leaf reading. When you take tea leaves and you like see what patterns they make. It's not to say like technical analysts don't have a place. It's just that you have to realize that, how much of technical analysis is a result of luck and how much is it a result of actual skill. I think most technical analysts we see and we talk to, I'm not trying to bum people down if you're doing technical analysis, but most of the ones we see are the survivors. And what do I mean by that? This is called survivor bias. Is that you could have 100 people doing technical analysis, right? And out of it, maybe like only 40% of them survive. That means that they make a profit in the market, and only out of those, maybe like 3 of them are prominent technical analysts. And everybody looking at that event are like, oh, those 2 are great technical analysts. They did stuff better than everybody else. But most likely they're all reading the same books. It's just that those 2 guys were lucky either because they were in the right time or they read it a little differently, but it's all sort of random. And the survivor bias means that we put a lot more weight into the opinion of survivors than the people who die. There's a reason for that, but at the same time, you have to realize it's a bias. And I think the typical example of survivor bias leading to wrong conclusions is during the Second World War. I don't know if you read about this, is that you can look it up, it's well known, is that they would send, I believe, bombers. It was the Flying Fortresses out and to bomb, go on bombing runs. And what the engineers were doing, they were looking at the survivors of the run that came back, and they would reinforce sort of the areas that the planes were hit, which means that they saw that most of these planes, they had a lot of hits on the wings, and they would be like, okay, this is where our enemies are shooting at, so we will reinforce the wings so that more planes can come back. They were wrong, because afterwards a group of mathematicians joined the analysis team, and they saw that actually no, what happens is that these survivors are the ones who are hit on the wings, and the wings are least vulnerable. It's all the other areas which we cannot see that are vulnerable, and therefore we need to reinforce the rest of it. So what does this mean? How can we pull this to technical analysis? Well, you have to understand that the survivors are the ones who probably had, they took strategies that were least. They had strategies where the shift in the market hit them the least, right? And they were in positions where these items were not affected. It was the other items that they bought that everybody else bought that were toxic or that were not good for their portfolios. So what you have to understand is you have to look at the losers. Why did they lose, right? If we look at the 2008 crash, who were the losers? Well, people who bought massively into things that they thought could not fail. And for me in 2020, and things that were completely over leveraged, for me in 2020, I hope I don't get a lot of hate. I'm not trying to short Tesla, but I don't have any positions in Tesla. But for me in 2020, a company like that is Tesla. Tesla is, you have to think about it like this. What does Tesla do? Tesla makes cars, right? And we're right in the pandemic, and they are tech, but tech is not like everything tech is great. Would you invest in Airbnb right now? No. So why would you invest in Tesla? Like, you're not going to invest in the hotel industry because nobody's traveling. So why would you invest in Tesla? Because it's the future. I mean, they put a battery in a car. It's not the hardest thing. The only thing that they're doing differently is they're trying to control the sort of the electrical charging distribution, right? They're making their car chargers proprietary, and they're trying to have the largest network of car chargers, kind of like sort of a physical Apple store, like what Apple does. Where's the problem in that? Well, the problem is there's a competing network for petrol. petrol is super cheap right now, like because nobody is traveling. Here's the thing: if nobody is traveling, what the hell is the use of a car? That's the thing. If people are saying that I don't need to commute, I don't need to do a daily travel, and what am I going to buy a car for? That's a problem. Car sales have been rebounding because new car sales have been rebounding, but old car sales are going down because people don't. Overall, I think the overall demand for cars is sort of flat or going down because with Zoom and with all the changes to sort of streaming and telecommuting, people are going to commute less, which means that in the midterm, at least in the new economy that's going to come out of, I would say, the current situation, we are going to see less purchases, or we're going to see a downward trend in the purchase of personal transport vehicles. We might see, I think we might see this is an increase of sort of personal vacation like camper cars. If I told you camper cars would be a great investment in 2021, and I told you this in 2018, people will laugh at you because they'll tell you, oh, why would you need a camper car? You can just go Airbnb, you can take a jet, you can fly around, there's such great transportation for everybody. Yeah, but they were not, there was no Corona back then. So Corona changes this. You don't need a short mileage commute car, which is what a Tesla is. If people are going to buy they're going to buy vehicles, they're going to buy larger vehicles like a camper car that, that serves as a vacation home, but also as a get the fuck out situation vehicle. And people are going to buy, I think camper cars are going to go up. There's not many camper car vehicles. There's not many camper cars. I think most companies stopped making camper cars because they were not profitable. After the 80s, people stopped using camper cars. So potentially we might see a rise in camper cars. That's more of that's an opinion. It's what I think. But I think normal vehicle companies, they're not going to be doing so great unless they're making camper cars. That might become a bigger part of their business. Do I think Tesla's a good buy? No, they're not diverse. They don't make all sorts of vehicles. They don't have a pivot, right? If you're like Honda, Volkswagen, Mercedes-Benz, BMW, they make a whole range. They don't just make cars. They make trucks, Volvo, they all make trucks. They make the whole spectrum of transport vehicles. Do I think transportation will be important in the future? Yeah. Do I think, for example, maybe personal vehicles will decrease, but delivery trucks will increase in sort of sales? Yeah. But do I think Tesla makes delivery trucks? No, Tesla doesn't make delivery trucks. So they make personal transport vehicles that people buy as commuters, and I don't see a future for that. There will be a future for that, but I just don't see it as a booming business. That's why I'm buying also Platinum, because I think, transportation trucks, electrical vehicles, trucks are not great as transportation trucks, because imagine if you have to transport, you have a certain deadline and you need to stop every single 30 minutes to refuel at a gas station, it becomes quite costly. So yeah, the other option, the faster fueling option, longer range, is hydrogen. And I think if we're moving on to cleaner energy, most likely we're going to see more hydrogen large transportation vehicles being adopted. That's just an opinion, though. I don't know if it's true. Honestly, I don't know. So I'm not a financial advisor. You can take it. I'm a dude with two hands on YouTube talking to you. If you like the content, click like. I do daily content. So subscribe and click the bell notification icon to get notified when I post new content. And leave a comment. I learn a lot of stuff from everybody. I learn about different countries, the tax laws, how different cultures perceive gold and silver and platinum, and what type of, and also people, what are their backgrounds. I learned that some of you guys are used to be traders. Some of you are working different businesses and so on. Some of you are business owners, so on. It's pretty cool to talk to you guys in the comments. So leave a comment below, and thank you for watching. Dave out.